Introduction. With such moderate abilities as I possess, it is truly surprising that thus I should have influenced to a considerable extent the beliefs of scientific men on some important points. Charles Darwin, last sentence of the autobiography of Charles Darwin, 1809 to 1882, August 3, 1876. Ben Graham taught me 45 years ago that in investing it is not necessary to do extraordinary things to get extraordinary results. Warren Buffett, Annual Letter to Shareholders, 1994. Evolutionary biology, as the name suggests, is the study of the causes and nature of the evolution of organisms since the beginning of life on Earth. Investing, unlike the name suggests, is all too often a euphemism for gambling in which the practitioners rarely do better than dart-throwing primates. Superficially, there are many other differences between the two fields. Evolutionary biology is practiced by serious professionals and the investment field is dominated by amateurs who take themselves too seriously. Knowledge and the quest for truth motivate evolutionary biologists. For most investors, knowledge and truth be damned so long as their 2x20 is protected. Evolutionary biologists perform a tremendous amount of research in narrow fields, example, secondary contact and genomic admixture between rhesus and long-tailed macaques in the Indochina Peninsula. Investors, on the other hand, make confident pronouncements, example, I think the markets will rise 10% this year, based on spurious spreadsheets, flawed assumptions, and inflated egos. The biggest difference, though, is that the two are moving in opposite directions. Evolutionary biologists continue to become better at their craft, whereas investors continue to get worse. In recent years, biologists have used Darwin's evolutionary theory to explain things like the origin of the human hepatitis virus, the consequences of sexual selection acting on female animals, the effect of microbiomes on the evolution of animals, the link between cultural inheritance among the great apes and Darwinian evolution, and the effect of gene flow on evolution of species. If you explore the evolution section of any scientific journal, for example, Proceedings of the National Academy of Sciences, available at www.pnas.org, you will be dazzled by the range of research topics and the stunning advances being made by scientists. But the investment community? It doesn't matter how you look at it, the data are ugly. Really ugly. And it shows that we, the fund managers, are idiots. According to a 2021 S&P report on the U.S. equity market called the SPIVA U.S. Scorecard, across periods of 5, 10, and 20 years, 75 to 90% of U.S. domestic funds underperformed the market. Let that fact sink in before you read any further. About 75 to 90% of fund managers, most of whom have graduate degrees, including MBAs, from elite schools and manage trillions of dollars, fail to beat the market. If you are part of the financial services community, you may believe that it is easier to outperform the small-cap market benchmarks. Not true. The market outperformed about 93% of small-cap funds during the 10-year period from 2011 to 2021. That is bad enough, but the dismal news does not end there. Not only are most U.S. funds underperforming, but they have also gotten worse over time. According to the same S&P report, in 2009, over 3 and 5-year periods, 10 and 20-year periods were not reported. Only 55 to 60% of U.S. domestic funds had underperformed the market. This phenomenon is not unique to the United States. In the Indian equity market as of 2017, 43 to 53% of large-cap funds had underperformed benchmarks over 3 and 5-year periods. However, as of 2020, those numbers had become much worse. About 70 to 80% of large-cap funds had been unable to beat their benchmarks over periods of 3, 5, and 10 years. No wonder passively managed funds have been growing at a much faster pace than active mutual funds. According to a 2020 Deloitte report, since 2009, U.S. passive funds valued at $6.6 trillion in 2018 had grown by more than 4 times, whereas U.S. active funds, valued at $11.4 trillion, had grown by less than 1.7 times. The reason? The performance of U.S. passive funds handsomely beat that of U.S. active funds during that period. I know you may now be asking the following questions. How in the world can an obscure field like evolutionary biology be a solution to this problem? What is it that investors' overpriced and overvalued MBA educations did not teach them that a study of Darwinian evolution could? What can the folks who worship abstractions like cash flow, price to earnings, PE ratios, and capital asset pricing models learn from the people who spend decades digging up fossil specimens, argue whether Neanderthals had sex with humans, and accord a godlike status to a 19th century Englishman who studied earthworms, pigeons, and barnacles? A lot, I will argue. But before we get there, who am I and why did I write this book? Who am I? I am an equity fund manager. In 2007, I founded an investment firm called Nalanda Capital, which currently manages a little more than $5 billion invested in listed Indian securities. Nalanda's investment philosophy can be summarized in 10 words. We want to be permanent owners of high-quality businesses. Let me repeat that. We want to be permanent owners. We don't invest unless we think we can own a business forever. A bad business that is dirt cheap? Pass. A mediocre business at a low price? Thanks, but no thanks. A high-quality business at a fair price? Give me more so I can never let go. We invest almost exclusively in businesses owned and run by entrepreneurs, of which the entrepreneur is typically the largest shareholder, and we are usually the second largest. Nalanda's approach to investing comprises 3 straightforward, sequential steps. 1. Avoid big risks. 2. Buy high quality at a fair price. 3. Don't be lazy, be very lazy. That's it. This straightforward investment process has led to the following outcome. 1 rupee INR1 invested in Nalanda's first fund at its inception in June 2007 would have been worth INR 13.8 in September 2022. The same amount invested in India's Sensex, the country's large-cap index, would have been worth INR 3.9, and if invested in the mid-cap index would have been worth only INR 4. Over a little more than 15 years, based on actual cash inflows and outflows, the annualized rupee return for this fund was 20.3% after all our fees, and the fund beat both the Sensex and the mid-cap index by 10.9 percentage points. That is not a bad track record. Before founding Nalanda, I worked for almost 9 years at the global private equity firm Warburg Pincus. Before that, I spent 6 years at the management consulting firm McKinsey & Company, serving clients in India, South Africa, and the United States. My consulting clients ranged from a South African retail bank, a U.S. technology company, and a Swiss insurer to an Indian conglomerate. As an investor, I have been on the board of an Israeli services company, a Singaporean food company, and an Indian telecommunications company, among a couple dozen others. My investments have been across early-stage companies, through which I lost money, to late-stage ones, through which I made some money. As you can see, I haven't done anything. I haven't been responsible for meeting production deadlines, managing a sales team, turning around troubled companies, or launching and managing brands. What I have done, though, for almost 3 decades of my consulting and investing career is observe. Not being in a day-to-day operational role has afforded me the luxury of stepping back to think about what works in the corporate world and what doesn't. This experience across industries, companies, and continents may qualify me to pontificate on the peculiarities of a pizza delivery business model, but I will not begrudge you for questioning my authority to speak on matters of evolution when I do not have a degree in evolutionary theory. My defense is the same as the one given by Mary Jane West-Eberhard in her stunningly original book Development, Plasticity, and Evolution. I can read. I blame my passion for investing on luck. I stumbled on this profession in 1998, and for evolutionary theory, oddly enough, on Charlie Munger, Warren Buffett's longtime friend and confidant. Munger was the chair of Wesco Financial until Berkshire Hathaway bought it in 2011. Like Buffett at Berkshire's legendary annual meetings, Munger held forth on a wide range of subjects at Wesco's annual meetings. In 2000, in response to a question about his favorite books, Munger recommended The Selfish Gene by Richard Dawkins. I read the notes of this meeting in 2002 and decided to buy the book. My life hasn't been the same since. I found the subject of Darwinian evolution extraordinarily fascinating and enriching. Thanks to Amazon and Borders, oh, I miss you so, I have been reading books on the subject for about 2 decades now. These include popular books, esoteric books, and graduate course books, books on insects, vertebrates, and humans. Books that deal with highly specialized areas such as genetics, and books on the general theory of evolution, books on the philosophy of evolution, and books that deal only with mathematical concepts applied to evolution. Yes, there is a lot of math in biology. I can't say that I am an expert in evolutionary theory, but I think I can hold a reasonably coherent conversation on the subject with an expert. By the way, I can't say I am an expert even in investing. I can admit only to being a passionate practitioner. Why this book? It was only after I had read dozens of books on evolution that I realized why I was so deeply absorbed in the subject. Almost every topic I studied in evolutionary biology has parallels to investing in general and to the Nalanda way of investing in particular. The more I studied Darwinian evolution, a new hobby, the more I learned about investing, an old passion. This book is about how we can derive the core investment principles of long-term and patient investing from the basic concepts of evolutionary biology, the very epitome of a long-term process. While this is a book on investing, it is not an Investing 101 book. I will not be discussing depreciation methods, lease accounting policies, or valuing intangibles. You can learn those things from hundreds of other sources. I will not be dissecting valuation ratios or commenting on off-balance sheet accounting. I also will not reveal any new investing techniques. This book is about adopting a new mindset for investing, about reimagining investing by applying the time-tested principles of biological evolution. I will deliberate the counterintuitive Darwinian evolutionary principles that can be called upon to understand the business world, thereby helping investors excel at their craft. What you will discover in the following pages is a description, not a prescription. It's a description of our strategy of investing at Nalanda and its uncanny parallels to evolutionary theory. Instead of saying, this is what you should do, this book says, this is what we have done. As mentioned, most investors have a poor long-term track record. The implication of this is obvious. Most investment methods don't work over the long run. Ours has. And so here I am sharing my thoughts with you. This book is for many types of readers. If you are an amateur investor, this book should intrigue you as you discover exciting parallels between the natural world and the world of money. Second, this book is for professional investors who are Buffett fans. Okay, agreed, everyone is a Buffett fan. This book is for Buffett fans who try to invest the way he does. While you may not learn any new tricks here, you will learn to visualize Buffett's core investment principles in an entirely new light as you peer through the lens of evolutionary biology. The third group who may find this book interesting is science buffs. Most people of science avoid thinking about money like the plague, but the opportunity cost of not investing well can be substantial. For those individuals, this book may nudge you toward thinking more actively about investing your money well, especially because the concepts discussed here will resonate with you. This book is also for readers with eclectic taste who are looking for something interesting to read. You may not find this book to be an Agatha Christie-esque page-turner, but hopefully your gray cells will be tickled. If you are an expert on investing, you may not agree with many or all of the investing-related topics I discuss. And if you are an evolutionary biologist, you may scoff at some or all of the themes I present. But the great thing about these two vast areas of knowledge is that there are almost no fixed laws in biology or in investing, in contrast to the many immutable laws in physics and chemistry. Just as scientists can't agree on the definition of what constitutes a species or a gene, investors have wildly different opinions on calculating something as simple as a business's value. The three elements of Nalanda's investment strategy. In this book, I describe one method of long-term investing and its parallels with Darwinian evolutionary biology, the way we invest at Nalanda as permanent owners. I have organized the book into three sections that mirror the three elements of our strategy. Section 1. Avoid big risks. Section 2. Buy high quality at a fair price. Section 3. Don't be lazy, be very lazy. Section 1 highlights the most basic investing lesson of all. Avoid big risks. Don't lose money. Like most deceptively simple things in life, this is easier said than done. Yes, not losing money is a skill, maybe a skill harder to learn than making money. As Warren Buffett has famously said, rule number 1. Never lose money. Rule number 2. Don't forget rule number 1. Have you noticed that almost every book on investing provides strategies and tactics that encourage you to do things a certain way? Some advise you to trade based on market signals, some recommend buying value stocks, and some urge you to bet on AI and biotech startups. These books are about making money. You do not see books telling you how not to lose money. The sad reality is that unless an investor learns to avoid losses, their investment career is likely to be short and brutal. Section 2 sums up Nalanda's second mantra. Buy high quality at a fair price. It focuses on the nuts and bolts of Nalanda's buying process as seen from the perspective of Darwinian evolutionary theory. Chapters 2 to 4 deal with what to buy, and chapters 5 to 7 explore how to buy. Section 3 covers the third area of Nalanda's investment approach. Don't be lazy, be very lazy. We buy rarely and we sell even more rarely. In this world of non-stop action where Nike's slogan, "Just do it," seems to be the core mantra of a successful life, our core tenet of "just don't do it" may seem out of place. In this section, I describe the logic of our laziness by invoking 3 concepts from evolutionary theory. I then conclude by drawing a lesson from an intriguing creature that even Darwin could not understand: the honeybee. In the following pages, you will encounter many facets of Darwinian evolutionary theory that have laid the groundwork for our investing philosophy at Nalanda. This book is a compendium of analogies. As you may have discovered while persuading or being persuaded by someone, analogies can be useful for making a case. Any case. So be careful. Treat the evolution lessons for what they are: a plea for investors to think long-term. Very long-term.